Good morning. Everybody is super energetic because today we're going to have one of my dreams event about loan officers because all the time we have a lot of panels with real estate people, but we don't have panels with loan officers. So we're going to learn a lot today. So thank you for joining us today as we explore the exciting world of loans specifically designed to benefit first-time home buyers. I am thrilled to introduce our esteemed guest of senior loan officers and managers of ICOR Lending, who will be sharing their extensive knowledge and insights with us. As we embark on this journey, it's essential that we understand the various opportunities available in the market. Our goal today is to equip you in the necessary information to make informed decisions and take advantage of loans that are within our reach. Throughout this presentation, our experts will guide us through the key aspects of these special loans, highlighting their benefits, their requirements, and how to maximize their potential. They will address any concerns or questions that you may have, ensuring that you leave here feeling confident and empowered to make your clients make the right choices for the homeownership journey. So without further ado, I invite our senior loan officer, and sales manager of Long Beach branch, Frank Mejia, to take the stage and conduct the event as a presenter and I'm moderator. Thank you so much.
Every morning we have a choice. Continue to sleep with your dreams or wake up and chase them. My name is Frank Mejia. I'm going to be the MC for this evening, for this morning. And I'm super excited and happy to have you here. Excited about the tools that we're going to get to experience with the amazing panel of speakers. Okay, they're here to share their knowledge, their wisdom, and everything else. And when I say amazing, these speakers, they've been in the business for many years. They know what they're doing. They know how to put deals together. And one more thing, they're going to show you something that nobody will. They're going to show you how to buy time. And when I say how to buy time, it's like time is the most important asset that we ever have. For us, for some of us that are about to turn 60, 70, 80, we only have this much, right? For those of you who still have a lot of time, don't waste it. Here at ICOR Lending, we're going to show you how to buy time in two ways. One at the beginning of the program and one at the end. So let me introduce you our first speaker. That's Gonzalo Corona. Please give him a round of applause.
And definitely, it seems like you guys want to put effort and knowledge, and it is a tough market. So basically, one of the things is to still be active, even though we're this small things like this. Even though maybe you guys already been on the business for so long, you already know a lot about the programs, but it's also to be interactive, to be aware about what's going on with the market. So one of the things that, first of all, that Sonia, I want to thank you for the opportunity. And when I received your calls, she's like, Gonzalo, I want to see if you can be in the speaker for one of the programs. I'm like, okay, I can do that. And what program do you want to speak about? So like, what about the programs in general? Why is that? Because sometimes we already know like the basics, but for me, it's a little bit more about getting to know a little bit deeper into it because that can save a deal for me. And one of the stories behind it, it's I'm coming from my background. I was a realtor back then, back in the days. Okay. And I remember my fixed experience in an open house, and it's a lead coming our way. And he has a question, a simple question. Can I buy a home with 1 year income taxes? And I grabbed my phone and said, like, just give me 1 second. I was trying to reach out my lender, and my lender he wasn't available at the moment. He walked out of that appointment of that open house. We went to a different open house. And the next day or the following day, somehow I reached out to him and said, I already have the answer. He said, like, sorry, too late. I went to another open house, and the realtor who was on that open house was able to answer my question. And once again, those little things actually can be a favor for and it can be a deal at the end of the day. So I'm gonna start how the programs really work. Let me see if I think can, oh my bad.
You can hear us.
Okay. Oh my God. Let me see. I was in Canvas, so now how do you, this is not
Still there, right?
mine. Okay, see how do you do, okay, gotcha. Oh my goodness. Okay, so we all heard about all these programs, right? Conventional, FHA, IT, NLP, DOE, 1 year, DC Arts, all that. But how it really works, those programs? Any idea how many of you guys have been on the business for quite a bit that can give me an explanation or something that you kind of know the difference between those programs?
They all have different guidelines.
They do. Why is that? Because there's a different investor behind those. Okay, so you guys,
Yeah, get close.
this actually is my first time presenting. So basically, we already all this kind of the program here, the program that, this program, the new program come in, and that kind of bring a lot of questions. Can I buy with the actually it's on our second slide. I'm not on my computer. And that kind of brings a lot of questions. My FICO 720, but I haven't worked for the last 3 years. I want to apply for down payment assistance programs, but I have my bank statements as a proof of income only. So we have all those questions. So sometimes what happens, we as an individual, we're trying to utilize loans that add agency programs and non-QM products. And that's why actually I'm trying to speak a little bit about those programs, the difference about agency and non-QM products. Everyone that?
Yeah.
You guys are getting lost? No, yeah, no. I'm so nervous, okay? But before going into that, once again, the rules are very, very important. It's not for you guys to get to know everything on that, but once again, you guys are the first face of your client. Sometimes we're as a lender, we are not the first face of the client. So it's you guys. The client comes with all those questions for you guys. It's okay. Can I buy with this? Can I buy with that? Once again, going back to the story. If you guys lose one question or you don't know how to guide them a little bit, you guys might lose a client. We're in a market where we don't have the privilege to lose one client, to lose one lead. Good?
Good.
So basically, the buyers comes to a originator, then it goes to a mortgage company, then goes to the investor. Why I want to touch that into the investor, because the investors are the ones who set the guidelines. At the end of the day, and there's overlays into that. They have the power to kind of do that, to see what's available on the market and what is not available in the market. Then it goes back to the servicer. That's when you won't hear the client, oh, my loan was sold. Basically, I would say like the majority of the loans are going to be sold to the secondary market. Why? Because as an investor, they don't want to keep that loan on their portfolio for so long. Then it goes back to Wall Street and goes back to the buyer. So basically, when it goes back to Wall Street, it's through mortgage-backed securities where now we as a buyers will buy those again. People who buy those, people who have a 401ks, IRAs, or IRAs, or any kind of investments. Basically, they're without not knowing that, they're basically buying those loans, and this is why the reason the interest rate fluctuates so much every single day, because that actually goes based into the Wall Street. And now, because our industry is so complex, now let's talk about the investor risk. Every loan has a risk, and based on that risk, that I want to talk about it because we're going to go into guidelines in a minute. So because of the risk, the lender choose where to want to go. Oh, we are a direct lender, we are a broker, we are a correspondent, we're wholesalers. We all have different guidelines, and this word is so complex, as you guys can see it, and I don't want to go deep into it. So that's why I was like, all right. So in order, guys, for you guys to identify how you guys can help your client, and it's at least get familiar when your client has a questions. At the end of the day, where when I put my clients in the agency programs and non-conforming programs. Agency is everything that the government it's gonna backed it up. The VA, the FHA, VA, those loans actually conform the standards and limits set by Fannie Mae. Freddie Mac are the biggest investors who buy most of the loans. And on the non-conforming loans, they're more riskier. Why? Because the lenders tend to keep their loans in their portfolio. That's why the when it comes to requirements, now as you can see, the agency people can buy with as low as a 580 FICO score with down payment of 3% down payment programs. We have conventionals, for instance. They can buy with a 3%. There's down payment assistance programs, no reserves in some cases. Now they require 2-year work history. Something we want to miss with this agency with non-conforming. For instance, I wanted to buy with down payment assistance programs, but I haven't worked for the last 2 years. So basically that is telling you that it's not gonna happen. But yes, it can happen with some programs that they don't require verification of income. But then we have to switch them to the non-conforming side. Those loans require a higher down payment. Does that make sense? Any questions so far? So good?
And a higher FICO.
And a higher
Any
FICO,
questions?
absolutely.
Please ask right now, because he's gonna give us the answer. Any questions right now? Not at all? Okay, so let's say which one is faster? The if I go non-conforming or with the agency?
Faster in which way?
Faster in the
In
process
closing?
of the closing.
It all depends on the structure. At the end of the day, it's a lot of work on our end, how fast I wanted to close the loan, and my team on the back end. But usually, there's not a right or wrong answer on that. At the end of the day, it's actually how fast we submit the paperwork to the underwriter.
Any other questions you may have?
Okay, so as you guys can see it, the non-conforming side, it's they have a higher requirements because most lenders they tend to hold those loans that they have a higher risk, and this is why we're gonna see that those conforming loans they require. I see non-conforming loans with as low as a 10% down payment. They prefer actually FICO scores 700 and up. They require reserves. So if your target audience is first-time home buyers, this one, and how can I explain to you guys? At least be familiar more with the agency side. Make sure that they meet the criteria with the actually that they're at least you make sure that they're gonna need at least 2 years of work history. Now, for me as a lender, when I'm taking a pre-qual, I only ask those 4 questions to my client. So obviously, my job is or our job as a loan officer is to ask a lot of questions, to go deep into questions as much as we can. But for me, the first 3 elements to ask my client is the income. I need to find out ways how am I gonna calculate my income, debt, FICO score, and savings. Those are the questions that you can prescreen your client, your lead, when you guys send over the phone or an open house, and more or less how much do you make a year? Oh, do you have auto payments? Do you have credit cards, student loans? What do you have? The minimum monthly payment, so you can add into them. What is your FICO score and what are your savings? Sometimes, honestly, I didn't even touch and run credit until I figure out that the income is strong and they don't have a lot of debt, because there's no reason for us to actually run credit when there's no income, other FICO is too low, and right on the back, I already know like they're not qualified. Sometimes I actually even top before into that into running to the savings. Once again, nowadays the FICO score, I mean, for us to run a credit, it's about $50 per client. So just assume that you run or we run. The first thing is, let me run your credit, and later on I have those questions. I identify their FICO score 700, but I told them that they don't qualify. They're gonna be mad because now I make them spend 110. This is a couple. I make them spend 110 in order for me to tell them that they don't qualify, something they could actually prevent since the beginning. Good.
Yeah.
Questions?
Very important.
And once again, those are the must questions to ask your client. Not because we don't want. Actually, I want you guys to call me and say, "Hey, Gonzalo, I have this and I have that." But once again, 5 minutes nowadays is actually it's a long time, because remember, clients they're desperate to buy, they need answers. They can go to ChatGPT and they can all find all those questions. So you want to have at least a conversation with your client and be able to help them out. So at least have those questions available to you guys and ask those questions because at that point you can know how to guide them. If that makes sense. And I wanted to use simple math. I think right now in a few more minutes, this is my last slide, by the way. In a few more minutes, you guys are going to hear about actually the more detail about a few programs. But for me, it's very simple. When I'm on the phone, I'm driving or whatever I'm doing, and I ask those 4 questions: what is your annual income, the monthly FICO score, and savings? So basically, what I do in my head is, okay, so if you make $72,000 a year, that's an equivalent of $6,000 per month. My DTI, I don't want to go into 43 to 46, 45, whatever it is. Tell her I have 50%, so your max mortgage payment cannot be more than $3,000. But let's assume that you have a car payment and you pay 600%, your max mortgage payment is not going to be more than $2,300. So now where can I find how much is gonna hold on that?
No.
And that's when you guys can tell your client, you know what, we need a co-signer because of this reason. You know what, how much are you? Okay, perfect, thank you. This is where you interact with your clients. To let them know that you're the expert, that you know what you're doing, and that you're gonna guide them and make them comfortable to work with you. And nowadays, clients want to work with knowledgeable agents, lenders, and they have so many tools available nowadays. The internet, Facebook, whatever internet, whatever they have all these questions, but they need to find someone who can trust, and our knowledge is gonna define that. So I'm gonna introduce Rick. No, Frank. Right?
Thank you, Gonzalo.
Do you guys have any questions for now? Okay, yeah, okay, now let me, we're gonna introduce, give me 1 second. Okay, she's a mortgage loan officer branch for the office in Whittier. Okay, her passion is to help, you know, to achieve their dream to own a house. Okay? And please let me introduce Abby. Give him a round of applause.
Can you hear me? No. Turn it up, turn it up. Yes.
So I'm Abby Ayala, and I'm with the Whittier branch in Whittier. So I've been in the business collectively over 20 years. I started from like receptioning in a real estate office to, administrative assistant to processing to now loan officer and branch manager. So today I am going to talk about our ITIN loans, a very popular program. We do have several different types of ITINs, but I'm going to touch on our 3.5 down ITIN. Okay. All right. Perfect.
I got
Can
you.
I switch with you? Oh, you're gonna do my.
I'll do it for you. Teamwork.
Launched in 2021. So we give your borrower a country qualified for standard agency mortgage ownership. It's a 40-year seller finance agreement loan, and it's a contract for deed that is signed, which gives the borrower equitable title interest. Okay.
Yeah, that's.
Oh, thanks. So how it works
got you.
is the customer applies for financing through their loan officer. And then we submit the application to our servicer for pre-approval. Once the servicer approves it, then your borrower can go and shop for a home. For their home.
Yes.
Okay. Again, it's a 40-year loan term. It's a fixed rate in payment. It does have a 3-year prepayment penalty which turns out to be 2% of the sales price. Okay. It will apply for single family condos and townhomes. They will do manufactured homes, but the manufactured home has to be built within 5 years. No mobile home, no lease land, nothing like that. Okay. And the FHA loan limits apply to this. Any questions so far?
Who's the servicer for these?
It's
programs?
Secret, high core lending.
So some of our underwriting requirements, so the max DTI for this is 42/55, okay? And if you're self-employed, the max is gonna be 38%. In reserves, you only need your first month's payment in reserves, okay? And that's due at closing,
Can that be a gift?
so it can be a cut.
Wonderful.
Okay, housing history, you do need to verify 12-month housing history, okay? And we'll get into detail on that. You can be self-employed to 99, and that's supported by a bank statement and P&L. Okay. For ITIN, you do need your IRS letter verifying your ITIN number, the date it was issued. Credit score can be 600 minimum, and 660 for self-employed. There is no housing income limit, so it doesn't matter what they make. There's no limits to that.
And I just wanted to reiterate, just ask you a question on, because it says there is 0 score also allowed, so
Yeah. No FICO is okay.
that's
You need
huge.
to build, you need to build credit through other sources like verification of rent or.
Yeah, so typically, if you have a FICO of 600 minimum, it's 2 trade lines that you'll have to be able to verify. You don't have a FICO score, it's 4 trade lines that you have to, like the utility bills, insurance payments, any type of alternative credit is okay.
Maybe I have a question on that.
Yes,
So, let's talk about trailers, authorized users. I know some lenders, they don't like to use authorized user. And that on those programs, they allow it.
I think it's gonna be a case by case. If all your trade lines are authorized user, they're probably gonna say no.
Yeah, maybe that's what.
Yeah, but if it's been, if they have other type of credit and maybe it's one, maybe we can get an exception. I think the basis of this and how strong their FICO score is and all the other factors in the file.
Oh,
Yes,
Quick question, do you guys already close on files with these type of programs?
it's a new program. We just rolled it out, so we do have files in process right now.
Because I had I sent a client with a different line. And they were in the process, but right after, supposedly we're gonna have the final loan approval, they start asking for a copy of at least the workers, like when you are not legal, but you have permit to work. And everything stops. I don't know, it was private bank too.
Yeah.
wow, yeah.
I mean, maybe they didn't get the pre-approval from the investor before, because that's big. Getting the pre-approval from the investor before, because you don't want to waste your realtor's time,
I know.
us as lenders. So that's a big step that for sure we will take to make sure that the investor approves it
Every loan, every time.
every time.
Mm.
Yeah.
I know, how far into being a resident you need to be in order to get approved? Do you need to have apply for the residency or NACA or
No.
any of those? Or
No, there's an I-10.
As long as you have the right. Yeah. You don't have to be a permanent resident. Yeah.
Okay.
Yes.
So,
No, no.
That's a good
I just registered with that.
right, and, oh, go ahead.
And the biggest segment. So they.
There is,
It just means that, no, there's no.
No, there's no
It's
insurance.
equitable, but the equity belongs to borrower.
So
in
they're
that
on
sense.
title and everything.
They are not on, there's like a contract that is done, between the investor and the borrower that basically gives them ownership rights, but they're not on the loan.
They're not on the loan.
Yeah.
They're on the loan.
I'm sorry, not on title.
So-
Then buyer.
When they refinance, they can refinance, into like a regular ITIN loan with a lower LTV after a few years. Once they fix their citizenship, they can always refinance into a conventional FHA loan. and it'll be 100%.
So who was entitled investor or?
Right.
Just to clarify that question, so it's called a deed in contract. That's what it is. So we're doing a deed in contract for them. Yes,
Can I jump?
yes,
in?
please do, because Chris is the expert.
For those of you, that, if this is the first time. The loan is done through an FHA loan. The borrowers get approved to go into a company and the entity is the one that gets approved. The entity approves the borrower first. So there's a third party that's involved here. So, for example, the ITIN borrower comes in, they go to that entity, the entity approves them because they go through, that's why the debt ratios are lower than you would normally see on an FHA loan, because there's a gap there between what the entity is going to be taking out on the loan. So the entity that is going to be on title is the one that's going to be technically on that initial loan that will be placed on title. Then there's a second contract between the entity and the borrower, and that's what the underwriting requirements are for that secondary. Because the initial is an actual FHA loan that the entity takes out on the property, and they're on, and then they have equitable title, which means that even though the third party entity is the one on title, they don't do anything without referring to the borrower first or the client or the homeowner, because they have equitable title. I hope that doesn't confuse you guys more.
I did.
You jump on it.
No, and just
Jump on it.
one more thing that's very important, what you just said, is what happened to you, that they sent the loan in. We will not issue an approval on this loan. So if you come today with your client, we'll just get all the information, gather everything we need, we send it to the investor. Once they give us the approval, like Christopher just said, that's when we tell you, hey, go buy a house. This is what they max, this is what it is.
It happens all before you go.
You even go into contract.
That borrower and an entity gets approved all before you go into the contract. Once you go into contract, it's kind of a done deal.
Right.
So, I noticed that there's a prepayment penalty.
Yes.
What if the client were to sell before that period?
They just have to pay
Pay.
2%.
Oh, wow.
Or the sales price or the.
Of the sale.
That's right.
It's a good loan. Mhm. It's a good loan, guys, for, come on, let's be honest. Our people out there, some of them are paying rents upwards of $4,000, dollars, $5,000, and it's not theirs. At least this way, they'll go in with 3.5%, right? Plus their closing fees, but they'll have a home. And yes, it's a deed in contract. Yes, there's another entity, but in 2 years, you're building equity. You're still building that equity, and then they could still sell it, or they could refinance it, and they got money. So it's a win-win. No,
Yeah.
no, not at all. No, it's theirs. Well, that's a big thing there, right? Hopefully they have a trust, right? And they have someone in that trust or someone that can take care of everything.
You think rate higher than the
Yes,
normal one?
it's typically about 2% higher than your standard FHA rate.
So it's not bad either.
That will be like a.
Like a non-QM.
Non-QM loan.
Yeah, it's not bad either, guys. I mean-
20% down.
Question.
Papers.
Yeah, good.
Yes. So we'll get into the income documentation
Mhm.
required, but that's not a problem.
No.
Because that's very common for
Right.
ITIN borrowers. Yes,
Is there PMI?
yes, it's an FHA loan, so yes.
All right.
So on the credit, like I said, they do have to have 2 open and active trade lines, so those have to have a running balance and still reporting. It can't be something that was paid off, years ago. It does have to have activity. If, like we said, there's no score, then you do need 2 additional open and active trade lines, utility bills, cell phone bills, insurance, any type of alternative credit. They only use 1 bureau for the credit score, which is Equifax. Okay, they're not going to use the middle of all 3. It's always just going to be the Equifax score. And again, 600 for W2 borrowers or 660 for some. So the good thing about this program is the way your income is calculated, it's just your year-to-date income average. They don't take past year's income and divide it over 24 months. It's whatever you made from January 1st to, let's say today, November 30th. You divide that into 11 months, and whatever that is, that's the second bar is budgets. Okay. There is no seasoning required for overtime, commissions, or bonuses. So if they got a bonus this year and you didn't get one last year, doesn't matter, you can use it. It's the same for overtime and commission. The documents required will be the last year's W-2, and that's okay if it has the social that they use to work with, because they don't even use the income on that W-2. It's just a requirement, documentation. And 60 days of pay stubs. So standard, we use 30 days pay stubs. This program uses 60 days pay stubs. Bank statements do need to support that 60-day of pay stubs. So they want to see maybe the direct deposits going in for the past 2 months. For self-employed, they're only going to ask for year-to-date P&L, 90 days of business bank statements. They're going to use the lesser of the two. So if you give me a P&L that shows their 100,000 in income, but your 90 days of bank statements only show that they made 6,000 a month, they're going to go with the lesser of the two. Less than 1 year of self-employed is okay. So they don't need to have a 2-year history. They don't need to own the business for 2 years or more. 1 year is okay for that. And then they do ask for the tax returns for the business for the previous year, but they don't use it, just it's a requirement. And a previous year's P&L. Okay, the P&L, sorry.
All right, wanna go back?
Go back, please.
Oh, too far. Oh, wait.
Yeah.
Let's go back. Wait. There we go.
The P&L does have to be provided by a professional or their bookkeeping program that they can show that they, yes.
So if a client is receiving W-2 for the first half of the year and then they begin working the second half as self-employed, would the year-to-date still be taken in place, or would it just be the self-employed?
So as long as we have the 90 days of bank statements for the self-employed, then they're
That's the
gonna
minimum.
use.
Okay.
Next. Okay, for cash to close, so customer must be able to document all cash to close. Typically, it's, oh, you're saying time now.
No. I'm trying to get the mic to work.
Typically, it's gonna be anywhere from 8.5% to 10% of the payment. Even though your down payment is 3.5%, you still have to factor in closing costs, that 1 month's reserve of their payment that they're gonna need. The beauty of it, it does not have to be seasoned, okay? Large deposits, okay. It just showed up, it's okay, as long as it's in their bank account, okay?
Mhm.
Gift funds are allowed. Yeah. To someone with a social and someone with an IT.
And they're gonna use the rate, the higher rate.
And going back to that, gift funds are allowed if they don't want to make this big deposit into the bank account, then just got a gift donor and that's okay too. They do allow up to 6% for seller credit. And then, like I said, 1 payment in reserves, your first payment is due at closing. Any questions?
No.
Okay. So 40-55 is the ratio, like I said, but there is exceptions to that. So if you're self-employed, it drops it to 38%. If it's your second home, it's 38%. If you have a BK foreclosure, short sale, drops it down to 38. No FICO is going to drop it to 38. And if you have payment shock above 200%, it's also going to drop it to 38. If you have 2 of any of the above, then it drops it to 36.
And this question is, I know they probably don't know, but what would be the timeline? Is it the regular FHA timelines of the 2 years for short sale, 4 years for foreclosures? Is it the same or different?
No, I think it's fine. There's no seasoning requirement.
There you go. So that is huge.
BK, it has to be 2 years or?
Yeah.
No, there's no seasoning. So that's,
No, that's the way I understood it. Yeah.
yes. So that's huge, guys. That's why I asked the question, because, you know, you might have people like that.
From 42% to 38%.
Right, that's. Right. So right now I'd be thinking a lot about who are you gonna get the next loan? There's a lot of loan officers here, okay? There you go.
So back to your,
Yes.
I'm gonna cut in there. Just so you guys know, if you guys have a client who's not an ITIN borrower, but they have a VK that they can't season and
So
still
this
wanna go through and
program.
have it set down, you can still take this loan.
Yes.
So if you, hey, I'm a US citizen and, but I just had a VK last year, but I wanna buy this house, FHA, you can still use this program.
And thank you for that, Chris, because that's thinking outside the box, right, guys? Yes.
yes,
Yeah, just use the program.
yeah, it's a with all the state guidelines where you don't have the seasoning on the bankruptcy or the foreclosure.
Everything that we spoke about applies, no matter what.
And then so for the housing history, like I mentioned, you're going to need one or of these three. So payment ledger, which is from an accounting system, management company, or a private party. 12 months canceled checks for rent, or your 12-month bank statements if it's an automatic withdrawal that comes out of your bank account every month. Unfortunately, if you live rent-free,
Nope.
it's not okay. Or if you pay cash and you can't document, they will not allow. Okay, so that's good. You do have to be able to verify your 12-month previous housing history.
Mhm. Yeah, that's a hard stop, guys, on that one.
Yeah. Yeah. So there are some additional requirements to this program. Big one is a home inspection, and the borrower does have to sign an acknowledgement of the home inspection, and all the major defects on that home inspection have to be corrected, such as plumbing, electrical, HVAC, roof. Anything major, there's no exceptions, they have to get them fixed, whether that's the borrower out of pocket or the seller contributes to help them get those things fixed to close the deal. Okay. They do also require home warranty. They require renter's insurance policy and payment protection insurance, and as well as the home buyer education course.
What do you mean by
So renter's insurance is a policy that they have to get,
as a buyer?
yes,
Mhm.
for additional protection.
Oh, because I put the title for this.
Correct.
Yes.
Mhm.
So they include the yes.
They are gonna have homeowners insurance, but on top of that, they also have renter's insurance and payment protection insurance. Yes,
Can you explain the payment protection insurance?
so that's if, you know, they can't make their payment because they lost their job or they had a hardship, and that policy will kick in and make the payment for them. So it's extra security for
So
the
they-
entity.
They get deported.
If they get deported, then,
There you go.
yeah, it'll protect them for a little bit and hopefully they can come back.
It will pay for the coyote.
Yeah.
Mhm.
And then post-closing, customer will make payment directly to the service. Customer is required to set up their own HOA, utilities, et cetera. Because they're living in the property, they're the owners. And so customer can refinance from equitable title into direct loan when they are ready to take on a different type of mortgage. There's no issue with that. However, if they do try and refinance 2 years prior to taking on the loan, they do have to get permission from the entity because they want to make sure they have enough equity to cover the refinance, the cost, everything. After that, they can do it and they'll have to pay the penalty if it's less than 3 years. They can do it after 2 years without permission. And then the payment protection and renter's insurance is added to their monthly check.
Questions?
And the seller pays what it was.
Yes, up to 6%.
Up to 6%.
That was just that slide. Yeah.
No, that's just thank you.
Well,
I did say we need about 8.5 to 10%. That would be their down.
How would you pitch the equitable title to your clients so that they feel comfortable stepping into this program?
Well, because it's the deed that's still signed to them, right? I would say just because of your situation, this is a temporary like. You know, and you are protected with this deed and it's here and the property is yours. And the goal would be to kind of push them to get
A
their
different
citizenship
program.
or get into a different.
And if the way to secure that 100% is if, how he mentioned was have kids in a trust or someone in a trust so that they could take over in any case they do get deported.
Yeah.
That
I mean,
protect you.
that's always a good idea for anybody, whether
Yeah.
they're legally here or not, yeah. To have a trust, yeah.
The property can be in California or anywhere.
They are approved in other states, but I didn't do my research on that. There is several, not every, but there is quite a few.
They are, and they're managing what they have.
They are,
So they'll actually.
right, because the equities is theirs.
Can you record something that states that you
Well,
are?
they're signing the contract.
Yeah, they're
Right.
signing
Yeah, but
it,
They
yeah.
have, it's a legal document.
Yeah, it's illegal. Everything notarized and.
If they each have the contract.
And
Yeah, it's a legal document.
so when they go to, if they go to sell 5 years from now, or they can choose to stay in the loan for 40 years and that's okay too. You know, they don't have to get out of that loan, but if they do sell or refinance and whatever equity is there, it's 100% theirs. They don't have to give a portion to protect entity.
All right. Good, thank you.
There is no introduction. He's been in the real estate industry since 1981 as a real estate spokesperson. He went into management and became partner of 5 offices in real estate brokerage in 1988. Now he's doing basically doing loans and let me welcome Ray to the party.
Excellent. There we go, right.
Thank you. I don't know if I even need this, but I'll keep it away from you so I don't yell at you guys. Thank you. Thank you very much. That's an interesting program. I know that we're running into clients all the time that are using ITINs and that right there can make the difference between someone buying a home and not. So I really think that that's something that can help you as a realtor get more deals and get more deals closed. So yeah, that was very good. Abby. Thank you.
Thank you.
Yeah, as you can see, I'm old. I've been around forever. Since most of you were probably born after 1981, at least some of you. But one of the things that I've really worked on my whole career is working with first-time home buyers. And one of those products that work with the home buyers are CalHAPA. That is the California Housing and Finance Agency. Basically, there's 2 types of programs with CalHAPA. One is FHA, which uses the normal FHA guidelines, and the second one is conventional. Okay. So this is how simple it is. I like to keep everything simple. That way I don't have to remember a lot. I take Nariva and things like that, but still, never mind. That was supposed to be a joke. What's Nariva? Nariva. That's something that helps you remember. No. We'll talk about that later, but
Here, Rick, if you could put this one over here, because they can't hear you over there in the.
Gotcha. Okay. Do you need both?
Yeah, because that one is for the.
Gotcha. Okay. All right. So the cool thing about on CalHAPA's website, they actually have a loan scenario calculator, so you don't have to remember anything. You go online, You go into the loan scenario calculator and you answer a few questions, and it tells you how the property or how the loan will work for a specific property. One of the things it asks you is a buyer, first-time home buyer. Simple question, either yes or no is the answer to that question. Is the borrower eligible for FHA 203H or California disaster? Many times the state of California has, if there was an earthquake or there was a flood or something like that, and the home buyer gets money from the state, they get extra help through the California 203H, through FHA 203H. In this particular case, though, the majority, we haven't had any national emergencies lately, or at least statewide emergencies. The Section 184 is if you are a Native American. I think that's the politically correct way to say that. Remember, I was born in 1981, so if I don't say it politically correct, I'm not intentionally doing that.
I'm sorry. You were born in 81.
No, not 81, no. I apologize. I got into business in 1981. I don't look like 1957. 1957. I didn't know there'd be a test. I really apologize. Okay, let me answer no to this question. The borrower earn less than 80% of the AMI. In this particular case, in order to qualify for a loan today, they probably don't, because it uses not only the borrower, but it uses any co-signers that are with that borrower. Husband and wife, for example, both of them qualify. They're probably not going to buy much of a house, at least not in LA or Orange County, maybe in Kern County or another county, but we're going to answer no to that question right now. And then you select the county. It's a pretty simple drop down. All the counties throughout the state of California are here. Okay, but we're going to go with LA County because that's where I live. And that's where I've lived my whole life. Well, I lived in Orange County for a while. No, now I live in LA County. Give me the sales price. Who has a sales price? 800? I like those.
Pretty average, Reverend.
Pretty average. Okay, in order to qualify for FHA financing, you need at least a 640 FICO score. In order to qualify for conventional financing, you need at least a 660 FICO score. So if someone has a 625, 632, anything under 640, can't do it. What you're going to have to do is work with us and do a rescore for that particular borrower. Rescores are allowed, and they're part of the normal program. But let's say in this case that the borrower has a 650 FICO score. Let's go right in between the two. The dropdown asks for a property type. It's either a single family or condominium. It does not include units in there, so we're going to say it's a single family. And let me scroll down here. The closing cost, we estimate the closing cost at 4% of the sales price. 4% of the 800,000 would be $32,000. That's an overestimation of the cost, but I put that in there just so that we don't get any surprises at the end. And that's too many zeros. So the next piece of information right here is for the loan information. Let me again scroll down here a little bit. Most of the time, the first-time home buyer program, the easiest way to qualify is through FHA. There is a way that you can actually get the closing cost financed in the loan itself. Unfortunately, currently, because interest rates are higher than normal, the ZIP 2% and 3% program are really not available. So I'm going to check the box for none here. If we select the subordinate loan, now this is the down payment assistance. So with CalHFA, you can actually borrow the entire down payment, the whole 3.5% through the My Home program. Okay. So if you select My Home and the interest rate, we can look up the interest rate. You don't have to know what the interest rate is. I believe when I checked, it was at 6 3/4, but let me just double check. It's actually 6.5. So you see, there's now this would be the high balance loan fee. So there's a 7/8 charge on that. And that's why I calculate the closing cost at 4%.
That's today's?
That's today's rates. That's right now. 6.5%. So that's what you put in here. Oh. Yes. The high balance fee is 0.875. And we're going to go ahead and we're going to calculate the results. And scroll down, and it actually shows you everything that you want to know. So the base loan amount at $772,000, the FHA MI premium, the high balance fee, the total first loan amount, the down payment required, the $28,000, the My Home for $28,000. So basically, the borrower can get into that $800,000 home with $32,000 out of pocket. That would be the payment down below. It's calculating the property taxes based on 1.25%. The home hazard insurance is, I think it's a little bit, well, it's probably actually not high anymore. Used to be calculated a little bit higher, but it's probably $200 a month now because that's what homeowners insurance has gone up to. Then you've got the mortgage insurance premium, so the total monthly payment is $64.80. Generally speaking, our first-time home buyers are not buying an $800,000 home for the most part. But you can have co-signers on this. You can have the borrowers, you can have the husband and the wife, or the wife and the husband, depending on who makes more money. You can also have the in-laws co-sign. You can have brothers, sisters. Under normal FHA guidelines, you can have anybody co-sign with you. Because after all, we're all related somehow, some way, right? That's basically how the product works, how the program works. The same thing with conventional. If we wanted to do a conventional loan, just a couple of clicks of the mouse, and we can actually add a scenario. And let's see here, right there. We're going to select, let's select a conventional loan, and you can actually have 3 of them on here. So you can do the simple math. There's no CalPlus, no ZIP, in other words. ZIP stands for zero interest program. Okay, there's no, you'll get the 2%, and that's basically free. You don't have to pay any interest on that. You're going to select the same thing, the My Home. The interest rate on a conventional loan is slightly higher than FHA, and the conventional is 6.875. So that's what we're going to type in. The high balance fee, let's see, what was that high balance fee for conventional? Was 1.050. And the upfront mortgage insurance, generally speaking, depending on what the FICO score of the borrower is, if they have a 650 FICO, well, they actually need to have a 660 FICO score. So if they have a 660 FICO score or higher, you're not going to put them into a conventional loan because the MI is going to be way too expensive. Yeah, if they have a 740 FICO score or higher, you might be able to break 1% and get into the high 8s or maybe the high 7s, maybe the low 8s or high 7s. So in this particular case, it's not going to calculate because I didn't put a high enough FICO score on there. But let me just show you what it would do. Still gives us information. And you can see that the payment is a bit lower, but that's because we don't have the mortgage insurance on there. If the mortgage insurance was based on 1%, you'd be looking at about a $400 a month higher payment going conventional. So most of the time, you're going to be using FHA financing through CalHFA. Okay. Are there any questions so far? This is pretty simple stuff, right? I've known Grace for how many years, Grace? Have we known each other? Like about. Grace used to work with me when I was part of the real estate ownership. Yeah, Action Network. That was back in the early 90s. So
Rick, is Action Network still around?
No. No, it was put to sleep. The last thing I wanted to cover was VA. So I'm going to add that third scenario like we talked. And let's show what the VA is like. We're also going to use the same My Home. The current rates for VA. Or I can look here, I guess. So VA is also at 6.5%. Just like the FHA rate. And the high balance fee, there's 0.875. So we'll use that high balance fee of 0.875. The VA funding fee, it's going to depend. There's no actual mortgage insurance, but there is a VA funding fee, just like on all VA loans. If they've never used that loan before, and it's been, I'm testing myself now, testing my memory. Chris, what's the VA funding fee? 2.25? See, I was going to say 1 7/8, but right. And there's a chance that there's no funding fee at all, but I'm going to say that there is a funding fee in this particular case, and that's going to be about 16 or 17, it'd be like $15,000. Yep. Okay. So at the bottom here, we have all three of our loan scenarios. And the bottom line is it shows the total payments. It shows the total cash needed to close. I'm sorry. You know what I did? I put that in the wrong spot. So the monthly mortgage insurance is actually 0. And we're financing the funding fee anyway. So let's do that again. Okay. So the lowest way, or the less monthly payment, the lowest monthly payment is actually through VA, if the client has a VA. I'm going to go ahead and make an adjustment to that scenario number 2. So if you're doing this loan while you're with a client and you want to make adjustments to it, you can easily do that right here. And I'm going to put the mortgage insurance at just calculating at 1%. Pardon me? Sorry. Based on 700 per month, it's going to be about that. And I'm going to calculate the results again. And all three come up. So this is more accurate. So the VA would be $6,000 a month. The FHA would be $6,480, and the conventional would be $6,725, provided the client had at least a 660 FICO score to do the conventional. This is something that you could show them in a relatively short period of time, and it's a very easy way for someone to qualify under the normal FHA guidelines. So I see you guys kind of staring like what, is there any questions? Like, what am I talking about? Does anybody know? Does this make sense? Anybody? Yes. It does at 1% interest, simple interest. This is right. This is CalHFA with FHA guide. That's when the first column is a CalHFA using FHA guidelines. The MMI credit. I mean, it's a deduction on your taxes, if that's what you mean. Yeah, it's a write-off, just like the interest that you're paying on the mortgage and your property taxes. Yeah. Yeah, the everything but the insurance is basically a tax deduction.
And guys, what you just said about, does it accumulate interest, it does, but there's no payment on it. And if the 1% simple interest, what he meant by that is literally take 10,000 times 1%, that's $100. That would be paid. Right?
Well, you're not paying it. It just, it's adding on to the loan. So. Right, over the 30-year loan. So once you pay the mortgage off, if you don't refinance, which I mean, personally, interest rates are probably, I'm not going to say double what they will be, but they're probably 50 or 60% higher than what they will be over the next 2 to 3 years, not based on me, but based on Wall Street, based on what people that do this for a living are projecting. Wall Street right now is predicting 3 cuts in the federal discount rate next year, in 2024. So that's the Fed discount rate is going to be 0.75% lower than it is today, which should equate to mortgages almost a dollar for dollar reduction in rates, which is a good thing. So yeah, that simple interest. If you have a My Home of, let's say, the $28,000, that's $280 a year. I think the appreciation is going to more than make up for that over the next few years. How about anybody else? Any other questions anybody has on this? No?
Okay, I just want to mention on the second that he was talking about of the closing costs, 2%, that one has no interest. That's why they call this SIP.
Right. That's correct.
It's not available. He showed it to you at 7.75 if you want it.
If you look at this right here, let's go into the so on this screen right here, can I make that full screen? Yeah.
Yeah. Right.
So you see the different products available, and right now the conventional 3% is not available. You see the NA right down here? That's the 3% SIP. The 2% is there, but the rate is 8.125. Okay. On FHA, it has the 2% also, but instead of 6.5%, it's 7.75%. So generally speaking, I think, well, you know better than me, the realtors out there, how many sellers are willing to pay closing costs on behalf of the buyer? Pretty much everybody, right? Pretty much every motivated seller. Yeah. So I would go to the seller as opposed to raising the rate up 1.25% to the borrower to pay these closing costs. Any other questions? Any comments?
If you selling or refinancing, is there any shared equity on that?
No.
Second?
This is 100% your borrower's money. There's no, they get 100% of the equity through refinancing or selling.
No prepaid.
Nope.
Nope, no prepayment penalty. Any other questions? Thank you guys for taking the time. Thank you.
Got this. All right, Frank, go ahead.
Let me do it. I gotta do the last one.
Oh,
Okay.
yeah.
21 years in the business.
That's it.
21 years. That's a lot of years.
Only 21?
Only 21.
He's like a rookie to me.
He's an expert in all kinds of loans. From purchasing your first time home, refinancing, and investment. Please help me welcome Mr. Alfonso Sari.
Oh my God. All right, so thank you so much first of all, guys. Wow, I am loud, huh? I want to thank you for coming, and I know you've been sitting here a while, so please stand up just a minute. Just stand up, shake it off, please. Because guys, this has been great information. Stretch, right? It's good to stretch. There you go. Now we can sit back down. And thank you for that. You see how I commanded all of you? All right. So I do love the mic. No, I'm just kidding. Where am I? Right. So today, I mean, I love it because guys, we're giving you ideas. Okay. This is a plethora of a lot of things. We do all types of loans. I mean, every lender does, but it's that partner that's going to be with you in that corner no matter what. And what I mean, no matter what, it's like good news, bad news. I don't believe in that. I just believe in news. Let's get it done. Let's work together and let's get to the final finish line. Because I don't get paid and you don't get paid if we don't close and we help people, right? And that's the most important thing here. So that's why all this information, guys, you know, what Gonzalo shared, what Abby shared, also what oh my God, Rick Kessler shared. It's all important, guys, because this is to help you. And I'm here to bring you one more item that I want to share with you, you know, and I want to just mention that because you guys said, oh, you know, who's giving closing costs? Guys, they're giving closing costs like crazy. Right now, I have 3 live escrows new builds. And the agents didn't even ask for anything. And they're like, oh yeah, we're gonna give you $25,000. You know, and I'm like, dude, ask for more. Like, ask for more. Like, ask for more. And we did. And one of them, we actually got like $5 grand more, which we're closing today. Hopefully it's gonna be funded. And that one we did in 20 days.
Wow.
And we had bumps in the road. We had Veterans Day, we had turkey that, you know, everybody was like just turkey driven, right? But we still closed it on time, right? Ahead of time, actually.
Alfonso,
Yes.
we can minimize the space so we can see each other. We can see
Of
ourselves.
course. You know what? I like to see myself, so let's change the camera.
Yeah, pull yourself.
Oh, yeah. We'll do that real quick. Let's see, integrated camera. It comes on. Doesn't like me, you see? Telling you. Oh, we can change that later.
That's because it thought I was still up there.
That's right, you know, Rick, darn it. Yeah, that's what it was, huh?
I have that so it
Alright,
doesn't
let
show me.
See here, I'm gonna search for something, because I'm giving you ideas, guys. And all these things, you know, right now there's a lot of the things that are moving forward. And guys, let's address the elephant in the room before I go into this. One thing that I want to share with you, yes, rates are high. That's undeniable. But you know what? Rates are still good. And the reason that they're still good is because let's think about this, guys. Prices are not going down. I don't think they're going down. What do you think is going to happen when what Rick said that we're going to have, how many was that?
3.
3 downward feds, you know, they're going to eat up what they gave us. They're going to eat it back. So that means that people are going to be like, okay, now I'm going to buy. But they're going to end up paying the same thing because guess where prices are going to go? Right. So if I were, you know, a financial guru, which I'm not, but I think I would pay 8% to get 30. Would you do that? Would you pay 8% today to get 30% in 5 years? Would you guys do that? Yes or no?
Yes.
Right. So this is how you have to plan it to your clients, guys. Because some of them are stuck on, well, the rate is high, this, that, the sky is falling, everything is bad and whatever. No, it's not. Because yes, you lost your boat when in 2020 and 2018, the rates were at 3, at 4, at 5. You know, those people made money, but you can still make money. You can still buy today because right now, especially right now, guys, the sellers are motivated. They're giving money. Sorry. Oh, thank you. They're actually giving money. They're actually helping people, right? And there's not that much competition, guys. Haven't you noticed that your offers are being accepted a lot faster now? I mean, you guys are agents here, right? So you've seen that, right? And that's what you have to tell your clients. We have to change the narrative, guys. It's up to us, right? If we don't educate the clients, they're going to be listening to CNN. They're going to be listening to Telemundo, you know, the sky's falling and all of that stuff. No, it's not. We just have to educate them and let them know, look, this is an investment. Esto es un patrimonio, right? This is your wealth builder. Would you, and ask them that question, would you pay 8% to get 30%? Because let's think about that. If they pay an 8% rate today, while they're paying their mortgage down in 5 years, what's happening to the principal? Going down, right? And what's happening with the prices? So what's that called in between? There you go, right? So you can get to that 30%. And woohoo, I got to 20%. I'll still do that all day long, right? For 8% get 20, I'll do that all day long. So that's just a little tidbit, guys, to, you know, because 2024, guys, if you really want to make it, you just have to work hard. That's it. And if you really want to succeed, you really have to educate yourself, educate your clients. And that's why it's great that you guys are here. Because all these programs, guys, are something that can definitely help you out on that. And one of the programs that I'm going to be speaking about is that has been coming up very, very rapidly. And it's a program that we just got approved. By the way, yes, you saw who it was, my investor, but no one could get approved with them, right? Because I just found out that they were not accepting anyone. They accepted iCore because we're awesome. Because Christopher, really, because Christopher, he's the guy. And we're awesome, right? So, but what I'm showing you guys here is that they have programs for manufactured homes, guys. That's becoming popular now. I don't like them. I'll be honest, I don't. But let's be honest. Some people that want to live in Whittier can't afford Whittier because it's too much. But they can afford a mobile home, $200,000, and yeah, they're gonna pay like $3,500 because of the land, but they're coming in with a lot less money than a really regular home is. And at least you get them into something that's building something, right? It's not gonna build equity a lot, but at least they're paying down on it and they're building something in savings. Okay, and that's the bottom line.
And I think the realtors still get paid too.
Oh yeah, that's a wonderful thing. And these are easier to sell. Guys, I just did one, like it was really, I was amazing. And the reason that I did not close it, because I'm very, very upright with what I say. I don't lie or nothing like that. The reason I didn't close it because the agents, they told us the truth that it was a 1977, but yet when the title came in, it said 1971. I don't know. They might have just, thought it was a 7 on the end or something. So we couldn't do it because it has to be 1976 and above. And they have reasons for that. The asbestos, the, lead issues, all of this that were built prior to 76. That's the issue. But you could do, and there's programs that we've got up to 550, guys, with 5% down. That's what I was doing. And the approval process is very easy. We have to just make sure that we complete a form. Literally, it's just a form saying the manufacturer date, the build, what type of length it is, the width. We have to say who the park owners are, their number. Then, of course, we give, the information, the income documentation for the buyer. But it's very easy. They go up to 48%, okay, for max DTI, right? And they could buy down the rates if they want. But if you see right now, you could go as low as 5%. And if you have a 600, yeah, your rate is high, but you're only financing 150,000. So the payment's not like overwhelming either. So these are ideas, guys. And the reason that I share this with you is because it's becoming more popular. I do a lot of Facebook ads, and I've been getting a lot of people like, hey, I can't afford to live in Orange County, but I saw that I could buy a $250,000 manufactured home, and it's a 4-bedroom, newly done, and at least I could stay in Orange County. Right? I don't have to go to Riverside. I don't have to go to San Bernardino. Right? And that's the opportunity for you guys. Plus, I don't know, find out with your brokers, but they tell me that you literally could go to the sellers and you can kind of do like a double escrow where you could, sell it for more. You just ask them, hey, how much do you want for this? And you could literally sell it for more, because I've heard that going around, right? And I'm like, oh, wow, so they're making money. So don't get confused on that, because there is some people making a lot of money on these mobile homes, agents, because that's all they do, right? And I've gotten into this world more, and I'm like, oh, wow, yeah, it's little bits, right? But 10 of those little bits make a lot, right? Yes. And it's leased land. But we also have where we could do manufactured homes, and that's an FHA loan all day. We could do a manufactured home if they own the land. So if there's a land on there, right now I'm working with someone for a USDA loan. There's a manufactured home on it. The guy, He's in agriculture and he sells chiles, jalapenos. And he's Chinese, by the way, weird, but yeah, he sells jalapenos. They like spicy stuff. And it's 5 acres, and we're doing a USDA, because the guy that wants to buy it, he's also Asian, but he's a student of agriculture or horticulture. Right? I didn't want to mess up that word with my Spanish, but that's why he's moving out there, because he wants to take over that business, and it has a mobile home on it, a manufactured home on it, right? Now it just the manufactured home has to be with I forget the name of it. It's on title. Lisa's not here, but it's a title recorded that it's a manufactured home that it does have to have.
Foundation 451.
Right, 450. There it is, 450. I was gonna say 433, so that's why I didn't want to butcher it. But yeah, if it has that, you're good. You can do the loan 100% USDA as well, guys. I don't know if you guys know that. By the way, Chino, a lot of the places in Chino are USDA as well. There's even in Anaheim. There's a lot of places that are USDA. Just people don't know. We just have to put it inside a map that we have. If the home comes up as a USDA, guess what? 100% financing, no MI. Hey, that works, right? So I'm just giving you ideas, guys. And again, thank you for coming, because and here, by the way, this is corporate, guys. This is where all the magic happens. This is where underwriting is. This is where my processors are. This is everything. Everything is here, right? And that's what I love about this, and I love iCore because I've been in a lot of companies, guys, but I love iCore for the fact that if I have anything, because there is no such thing as a perfect escrow. Let's put it that way. But guess what? I could go to my underwriter and speak to him. I could talk to Chris. He's one of the top dogs here, and you can still talk to him, right? I could talk to Yessie. She's also the CEO president. I can tell them, hey, I have this issue. Could you help me? Because they know they've done this so many years. They can help me and say, hey, no, we're going to pivot. This is what we're going to do. And we get it closed. And that is a partner that you want in your corner. And yes, that's my 5-minute iCore lending. Okay, pay me later, Chris. Okay. It checks in. You want me to make it better? That was good. Okay. No, but I really love where I'm at. And really, guys, you have to really choose your partners well, right? It's not about just closing it. It's about, who's going to be on your side all the time, right? And that's what we are here. That's why I love iCore lending. And all these products that we have, guys, I know a lot of other people have them, but again, we're the best. And we're awesome, right? And we close. And that right there, Sonia, what just Sonia said, that is so important, guys. You have no idea. And having the team that we have here, that's another thing that I love, because I could just come in here and ask anyone, like, hey, I need help on this. I haven't done this, and we get it done. And that is what you need in your side, right? And, again, we're all about truth and just getting things closed. So questions on like mobile homes, on anything that I just spoke about? Anything?
So the time that the manufacturer.
No, that is on the program for the I-10, which, guys, that's a great program. I mean, if I were you, I'd be thinking like, okay, who the hell I-10? I got like 5 of them. Let me call them. And because this is a sure thing, what she was talking about, it's not your normal FHA conventional loan where we issue a pre-approval to you like, hey, this, and we're human, okay? And we might have missed the overtime. We might have missed something on this. There's no missing anything because we have to send it for approval. There's no if, buts, or what. We have to send it to the investor. The investor tells us like, yep, they could do it. It's like literally money in the bank. Go.
45, 60-day escrow.
45 to 60-day escrow, though. Yes. Very important. No. On the I-10. No, on this one, guys, it's really quick. Like in 2 weeks, they were done. I was like, oh, well, I'm waiting for the appraisal. They're like, oh, no, we're done. I'm like, well, what do you mean you're done? They did a drive-by, right? Because they already know and everything. And like, they were like, I just need the title. That's all they asked me. And when I got the title again, I was like, oh crap, it's 1971. Right. He might have thought it was a 1977, like I said, right? But anyway, the buyer's looking for another property, thank God. So, but yeah, the programs that we're all telling you about, guys, they're all awesome. I mean, they're really good. They could get people in homes, and that is important because we live out of referrals. You help someone that thought that they could not get into a home, and guess what? You're gonna become. They're gonna become your super fans, right? So that's all we're trying to do, guys. Put money in your pockets, showing you the things that are out there. Okay. And again, we're all from ICOR here. All the loan officers are here. Please, everyone from ICOR, if you could stand up so they could see you, the agents, please. Any of these that stand up, call them, talk to them, please, ask them, right? So thank you, right? And definitely give yourselves a round of applause because you guys are here and you got educated. I don't want to take much more of your time because we did promise till 1:30. And I want you guys to eat something, right? Because I am not gonna interrupt the program, Sonia. Yes, Mama Sonia. Go ahead. I am done, Mama Sonia. Yeah, you're welcome. All right.
Related to the lunch. Okay, so please, I want to just invite everybody to come over. Abby, please have a seat. Alfonso, Rick, Gonzalo, and I want to invite our president of the bank, Mr. Lopez, to as moderator.
Yes.
Just have a seat and enjoy being moderator.
I got you. That's where it was. I was looking for it.
Hello, everyone. For those of you that don't know me, my name is Christopher Lopez. I'm the president of ICOR Lending. Thank you all for coming. I appreciate it. And thank all of you guys for talking today. So I'm actually just going to ask a couple questions, some of the things that we talked about, kind of recap a little bit about what we talked about today. And again, this is time for if you guys have any questions, please let me know. We'll ask. I'm going to start with you, Gonzalo. I heard you talk about the difference between non-QM and when you start that interview with those clients, do you do it face to face, like do it over the phone? Where do you see you get the best results?
Well, the best results on my end is face to face. I've done Zoom calls and I've done call calling or over the phone. But the most important part is the interaction with people. We have a longer conversation. We talk about something else, and that great interaction where we connect with people. That's answer to that.
Abby, for you, I know right now, experience of the business, going out and getting business. What do you find right now in the market? What kind of success are you having? What kind of frustrations are you having? I know that the 3% ISA we're talking about, is that just kind of a notch in the tool belt to kind of get you in the door and then you end up finding out that they go somewhere else? Or how do you see the business going for you?
So, I mean, for me, it's always 100% transparency with my partner, honesty, communication. Frustration, I think right now is just the borrower's not qualifying as much, right? But I mean, I do already see that kind of, I've updated protocols where I'm like, hey, agent, $50,000 more in the sales rates, you can go because rates have dropped, things like that. So just staying on top of everything, communicating back and forth. Been working. I don't know if I can get mentioned.
Yeah,
That's it. You got it.
Rick, I understand that you have first-time homebuyer seminars on the weekends. This is Alfonso here. When did you start that, and what kind of success are you seeing with that?
We've been doing that. I first, just let me tell you a little bit. I just joined ICOR November 1st. That was my day one at the new company, and so far 30 days in, I'm
welcome
really
to the
enjoying
familia.
I have done first-time homebuyer seminars since the 80s. That's what I've always dealt with. I started out in Norwalk, in the city of Norwalk. That's where I lived. That's where I worked. That's where I sold many of the homes that I sold. So I've been doing it for a long time. And basically, every single person, I think everybody here, if you don't own a home you want to own, That's probably 85 to 90% of the population wants to own a home. Unfortunately, not everybody can, but everybody wants to. So you're starting out with a great number, a great percentage, right? There's a high percentage of people that actually want to. And what I do is I show them, if they really want to, how they can and how they can buy. I think most of the times, or a lot of times, some of the lenders don't want to deal with some of these first-time home buyer programs because there's a lot of extra paperwork and they think it takes a lot of extra time. But if you're an expert at it, if you know what you're doing, there's no difference between a CalHAPA loan and a regular FHA loan. Or there's no difference between a VA loan and a regular conventional loan. The timeframes, if you do it right up front, are exactly the same. My goal with every single borrower that I deal with is to meet with them in advance, either share my app where they can take an online application if they want to do that, or I take one by hand with them. It's totally up to them. Whatever the buyer's comfortable with, I'm willing to do. I want to get all of the documentation up front, especially a first-time home. Want to get their W-2s, want to get their paychecks, want to get their bank statements. I want to get them approved as a TBD, to be determined. I want to get an approval so that when I give that buyer back to you as a realtor, you can go out and sell them a house. Also, by getting that TBD approval done in advance, we have a 2-week window sometimes that we can close it. Again, it just depends on the circumstances of the property, but we can close it as quick as 2 weeks after a signed contract comes in the door, if we've gotten the pre-approval done in advance. So when we're dealing with first-time home buyers, I love them. I mean, because, it's something that makes me feel good. I just love to deal with those people.
And I just want to do something about that because it's a misconception of the real estate agents that when they see an offer that is not a conventional, they don't want to accept the offer, thinking the FHA is like a big dinosaur. They're going to take like a 60 days close. And it's like you said, it's so important that we as an agent know what's going on with the loans and what is the time frame for every cycle, because it's a cycle. And we can close the FHAs in 15 days. So why the people don't accept? It's the same thing. Conventional FHA, VA, we close in 17 days. I close it 17 days one. They close for me 15 days. So ashamed to say that I close in 15 days.
Well, I think to kind of jump on what Gonzalo was saying earlier, someone had asked, is there a difference between closing a conforming loan or a non-QM loan? Honestly, it boils down to the client. If you have a client, especially you as real estate agents, when you meet your client for the first time, the more you can get your client to get on board, let them know that you're working, not for them, you guys are working together to get them their home. If you can right away say, hey, look, the quicker you get me whatever I need, or the loan officer, whatever they need, the quicker we can close a loan. Look, we can close a loan as fast as you can get us what we need. So it doesn't matter whether it's an FHA loan, it doesn't matter whether it's a non-QM loan, it doesn't matter if it's a mobile home, right? So that's not the issue. The issue is how quickly can you get your borrower to get on board? I'll ask you, the last loan that you closed with us, because you joked about it when you were talking, there's always bumps in the road, there's always escrow. Can you talk about something that came up in that escrow that was a bump in the road and how you overcame it?
Wow. So remember when I told you the sky is falling and the people are stuck on rate? Well, she wasn't buying the 30%, pay 7% now. And she's like, no, but I want a cheaper payment. I said, well, I'm gonna get you there, and the way I'm gonna get you there is we got 25,000, we're gonna do a 2-1 buy down, and you're gonna first year is gonna be this, and your second year is gonna be this. And the seller was like, well, Alfonso, that's great, but I'm gonna pay off the solar, because that's what she wants, and I'm already taking 19,000 of that, and you're saying you need how much? I said I need 12,000, and they're like, well, what can we do here? I said, easy, you're just gonna give me 12,000. All right, and this is weird because I'm not supposed to be talking about the the real estate side, but I was talking directly to the builder, like, hey, help me out. It's a matter of, because she literally didn't want to sign an LE. I had to do it manually, because she didn't want to do it, and that was one bump in the road. I lost a day there. But mind you, I had lost Veterans Day. And then on top of that, the builder, I ordered the appraisal really fast. She decided to do the appraisal on a Monday before Thanksgiving, right? So like, here we are, I'm like, lady, I need to hurry up because appraisal, I don't know when, it's not gonna come this week. And even though we got it on Monday, literally, this Monday, we were already ready. We were ready CTC and everything. All we needed is to get the CD out because we needed a CD out in order to do the 3 day, right? And the 3 days ended, guess when? Today. And she signed today, and it's under today, right? Well, and that was a major bump in the road, right? Because I told the builder, like, why did you do that? Why didn't you set it up like on Friday? Like you're putting me behind. And but you know what? She was so impressed with me. She sent me another one, and I'm right now doing another one for them, right? So, guys, and the same thing. They're giving $25,000. These builders are giving money, and I just got another one accepted from CEO Sandoval, and she said, "Hey, you know what, Alfonso? They're giving us $25,000. I didn't even ask. I'm about to ask for more." And I'm like, "Oh, wow, okay, cool." So builders are giving money, guys. They really are.
One of the, I don't know if you guys listen to CNBC at all, but I listen to that every morning. And the builders, they have Diana Olick is a real estate commentator, and she comes on every morning with a little report about real estate, what's going on. They said right now that most builders are buying down the rates into the low fives. The builders that are selling homes nationally are buying the interest rates down into the low fives. So if you have the opportunity to sell a new home, don't shy away from that, because these builders are motivated. They're spending hundreds of thousands of dollars on the land and on the permits and on the building, and they're willing to pay points to buy these rates down.
Yeah.
Yes.
Arizona.
There you go. So they're buying it down to 4.99.
Yeah.
And thank you very much for mentioning that. I want to jump on, I want to piggyback on what they're saying. For those of you that don't know, in the past, for those of us that have been in the business a long time, usually when someone comes to us with a brand new build as a loan officer, you're like, hey, if they've got an internal lender or a lender that's already approved on site, they're not going to give you the rebate that they would give us. They're going to close the deal with that internal lender. That's not happening anymore. So if someone comes to you and you're a real estate agent and they want to buy a new build, if you have the loan officer that you like, hey, bring them over, because they are giving discounts for, they are giving those, the credits for closing to paying for upgrades. They're buying down the rate. So don't shy away from that. In the past, you kind of had to go with their internal lender. We've closed more brand new build loans in the past 3-4 months than I think I've seen since, the past 3 years.
Yeah. And then it helps us, guys, because actually we're gonna do a good job regardless, right? Because it's dependent that if I do a good job, I'll get a referral from them, and I might become their internal lender. Right. So it's a win-win for everybody.
Do you guys have any questions?
Yes,
we
please.
have over 100 years of experience up here, sitting up
This
here.
way, that way. I only have one.
Just right here.